A wonderful day to you all. Welcome to Nifty Sense. Today we are peeling back the curtain on a market that, on the surface, looks like a calm pond, but underneath is a whirlpool of institutional maneuvering and historic diplomatic shifts. While you were enjoying the Republic Day break, the tectonic plates of the Indian economy shifted. The mother of all deals mystery. Why did the market suddenly pivot from a deep red opening to a sea of green by 3:30 p.m.? On the surface, everyone is talking about the India-EU Free Trade Agreement, FTA. But there is a hidden narrative. While the headline says free trade, specific sectors were actually being thrown under the bus to save others. Why did the kings of the road, auto stocks, bleed while the metal titans soared? Today, we decode the crossover between geopolitics and your portfolio. The Pulse Check, closing figures, January 27, 2026. The markets reopened after the Republic Day holiday with a vengeance. After an initial gap-down scare that saw the Nifty slip towards 24,900, the bulls reclaimed the steering wheel. Nifty 50 closed at 25,175.40, gaining 126.75 points, 0.51%. Sensex settled at 81,857.48, up 319.78 points, 0.39%. Market breadth. Despite the indices being green, the advanced decline ratio was skewed. On the BSE, 1,901 stocks advanced, while 2,209 declined. This tells us that the big boys heavyweights did the heavy lifting, while the smaller players struggled. Top 10 headlines. The impact chart. The India-EU FTA masterstroke. India and the EU finalized a historic FTA, slashing tariffs on 96% of goods. Auto sector tariff shock. The FTA includes lower import duties on high-end European cars, sparking fears of foreign invasion for domestic luxury makers. Axis Bank earnings power. Axis reported a stellar 4% growth in net profit, acting as the primary anchor for the bank Nifty recovery. Metal sector rebound. JSW and Tata Steel surged as the FTA opens a massive, tariff-free corridor for Indian steel into Europe. U.S. tariff clouds. The market remains wary of the Washington Wall, the ongoing U.S. policy on import tariffs affecting global trade. FII selling continues. Despite the rally, foreign institutional investors, FIIs, are still treating Indian stocks like a vending machine, pulling out cash. DII Shield. Domestic institutional investors, DIIs, are the insurance policy, buying every dip to prevent a market crash. Budget 2026 fever. The countdown to the February 1st union budget has begun, with infrastructure and manufacturing expected to be the darlings. Geopolitical thaw. Softening rhetoric between India and China. Xi Jinping's Republic Day message provided a silent psychological floor. Silver's moonshot. Silver prices hit a fresh peak of 3.54 lakh rupees per kilogram, signaling that the smart money is hedging against currency volatility. Sectoral pulse. Winners versus losers. Think of sectors like different floors of a mall. Today the basement was flooded, but the penthouse was throwing a party. Top 3 gaining sectors. Nifty Metal, plus 3.07%, the clear winner of the FTA. Imagine a toll booth on a highway being removed. That's what happened to Indian steel going to Europe today. Nifty PSU Bank, plus 1.76%. State-run banks are seeing institutional footprint as they prepare for massive infrastructure lending in the upcoming budget. Nifty IT, plus 0.80%, a safe haven play. When the world gets messy, companies go digital to save costs. Top 3 losing sectors. Nifty Auto, minus 1.45%, the tariff trap. Investors fear that European cars will now be cheaper, eating into the lunch of companies like M&M and Maruti. Nifty FMCG, minus 1.10%. High silver and gold prices are stealing the wallet of the common man, leading to fears of lower soap and biscuit sales. Nifty Consumer Durables, under pressure due to the same import competition, fears stemming from the EU deal. Institutional flows, the tug of war. FII net activity, 4,113.38 crore rupees, net sellers. DII net activity, plus 4,102.56 crore rupees, net buyers. The professional analogy. Think of the market as a joint family business. The FIIs are the external consultants who are pulling their fees out because they see a better opportunity elsewhere, U.S. yields. The DIIs, LIC, mutual funds, are the elder brothers who are putting their personal savings back into the business to keep the shop running. As long as the elder brothers have cash, the shop won't close. Green flag deep dive. 2 stocks in the accumulation zone. Stock 1. Axis Bank, the earnings engine. The narrative. While other banks struggled with margin compression, paying more to depositors than they earn from loans, Axis Bank showed a value moat through its digital efficiency. Institutional footprint, heavy buying was seen post-results. Analogy: think of a delivery company that figured out a way to use 20% less fuel while delivering 10% more packages. That efficiency is why the big boys are moving in. Stock 2, JSW Steel, the FTA frontier. The narrative: JSW is perfectly positioned to capture the European market. With zero tariffs, their order book is expected to swell like a sponge in water. Value moat: lowest cost of production in the world combined with a new, duty-free VIP pass to Europe. Analogy: if you owned the only lemonade stand that didn't have to pay a street tax, everyone would want to buy a stake in your stand. That is JSW today. The dark horse, Nifty infrastructure. While the headline index was volatile, the infrastructure sector is showing, quote, quiet accumulation. Why? The union budget is only days away. The government's business insurance for the economy is spending on roads and bridges. We are seeing a crossover, where smart money is moving out of expensive glamour stocks and into cement and steel companies. It's the infrastructure foundation being laid before the big announcement. The institutional footprint, deciphering the shadow war. To understand today's market, you have to look past the green numbers on your screen and look at the institutional footprint. There is a silent shadow war happening between the FIIs, foreign institutional investors, and the DIIs, domestic institutional investors, and today's data reveals a fascinating story of internal resilience versus external skepticism. FII cash activity, 3,068.50 crore rupees, net sellers, DII cash activity, plus 8,999.70 crore rupees, net buyers. The professional analogy, the foreign landlord versus the homeowner. Think of the Indian stock market as a massive luxury apartment complex. The FIIs are the foreign landlords. They own many units, but they don't live there. When they see a storm brewing in their own country, US tariff hikes or global inflation, they quickly put their units up for sale to raise cash. Today, they were dumping their keys. The DIIs, your mutual funds and LIC, are the homeowners. They live in the building. They know the foundation is strong because of the India-EU trade deal and the upcoming budget. Instead of panicking, they saw the foreign landlords selling at a discount and decided to buy 3 times as much. The crossover signal: when you see DII buying, 9,000 crore rupees, dwarfing FII selling, 3,000 crore rupees, by such a massive margin, it signals a structural shift. The market is no longer a slave to foreign flows. The Indian retail investor, through SIPs, has built a financial great wall that the global bears are finding impossible to break. Strategists note, this level of DII aggression usually precedes a pre-budget rally. The smart money isn't just protecting the market, they are positioning themselves for the next grand opening. The core lesson. Today's lesson is about relative strength. In a market where 2,200 stocks are falling, the 1,900 that are rising are your green flags. Wealth is not made by catching a flying rocket. It is preserved by identifying the structural strength of a company before the rest of the world sees it. Don't chase the noise of the FTA, look for the companies that have the infrastructure to actually deliver the goods.